Hello, all. Good morning. My name is Corey Hall. I am the founder and developer of Trading AI by Brainchild AI LLC. And today we are going to begin our Intro to Trading series where I'm going to show you how to use our trading agent product not only to make trades but to learn how to trade for those of you who have never traded before, have an interest in trading, or are new to trading and may not know all the ropes. So we're going to go over how to use the agent to start trading, set getting the necessary information, learning about the different types of trading that you can do. And in this series, we'll discuss stocks and options. So let's get started. So here we are at the main screen of our trading agent. To the left, we're going to come over here to new conversation. And this trading agent is a GPT. You can ask it questions. It's conversational, and it will give you the necessary information that you need. So I'm going to give it a simple prompt. I am new to trading and want to learn how to trade. What information, what things I need to know. Let's start with this prompt. It's going to process that query. Let's give it a few seconds. And boom. So, types of trading we got, day trading, which is buy and sell with the same day. Swing trading, which is hold position for several days and sometimes several weeks. And then investing, which is long-term holding for months or years. So these are trading basics, the three types of trading. Some key concepts that you need to know is stocks. Stocks are shares of a company. When you buy a stock, you buy ownership of the company. ETFs, which are exchange traded funds, are baskets of stocks. And ETFs typically have several different stocks in them where those stocks are equally weighted, or weighted based on the value of the stock. And so different ETFs can have the same stocks but different weightings. And so that's something that you need to pay attention to, and we'll get into that a little bit later in the series. Options are contracts to buy and sell stocks at set prices. Options are come in two styles. There's American style and there's a European style, which we'll get into that later. But essentially, when you buy a stock, when you are buying the option, you're buying the right to buy 100 shares of a stock at a set price. There's two types of options. There's puts and there's calls, and we'll get into that later. And then futures are agreements to buy and sell assets at a future date. Futures cover typically commodities, like cocoa, corn, oil, gold, things of that nature. There's also There's also index futures like S&P futures, Nasdaq futures, Dow Jones futures, and those are all cash settled. And so those are typically the four types of the four types of investment vehicles that you can trade. So as a trader, you're gonna need to know some essential terms. So bid and ask, which is the prices buyers and sellers offer at. So a bid is typically the buying price, and the ask is typically the selling price. Volume is the number of shares traded. And so volume typically is a measurement for liquidity, which is how easily you can buy or sell something. And that's something that you'll want to pay attention to when you get into a trade. You want to be able to make sure that you can get out of that trade, and you'll measure that by the liquidity. And then the volatility is how much the price moves. High volatility can create high price fluctuations, which can be good or bad depending on your trading strategy. There are trading strategies that do capitalize on volatility. like straddles and strangles, which are a type of options trade, which we'll cover later. Another term that you'll need to know is technical analysis. Technical analysis is using technical indicators to judge potential price movements or price action activity. So some of the ways that people do technical analysis is they use charts. Charting typically comes with your broker platform, whether you're using Swap, Thinkorswim, Fidelity, Robinhood, Webull. They all have some type of a charting tool that comes with them, and it's a way to visualize price movements, typically using Japanese candlesticks. On charts, people typically use indicators. Indicators include things like RSI, which is the relative strength index, MACD, and moving averages. Also, people use patterns. So there's a set of well-established, well-back-tested patterns that people use for both bullish and bearish trends. I think there's about 12 of them that are really established. And so those patterns that people use to trade off of that indicate strong bullish or bearish activity. And then, so fundamental analysis is things like earnings, company profits, news, events, which are events that affect prices, and then financial ratios and gap accounting measurements. So that's like price to earnings ratios, debt to equity ratios, EBITDA, which is earnings before debt, taxes, and amortization. And other financial ratios that you can see in their earnings reports and their asset reports. The big one, if you're going to trade, the big one that you need to know and you need to internalize is risk management. The key to risk management is a stop loss. A stop loss is a preset price to exit a losing trade. So this is when the market moves against you. You use your stop loss to prevent you from losing too much money. Your stop loss is what is going to keep you alive in this game. Position sizing, how much to invest per trade. And diversification, don't put all your money in one stock. So with the risk management, one thing a lot of new traders do that blows up their account is the amount of money that they're willing to risk is based on what they are potentially able to gain. That is a mistake. Do not bet that. Instead, make your risk management based around what you are actually willing to lose. So don't put $1,000 on a trade under the assumption that you're going to make $2,000 and then you lose your $1,000. If you're only comfortable with losing $100, set your risk management so that you'll only lose $100. And that way you will not blow up your account. And then 7 is trading psychology. Discipline, stick to your plan. Emotions, avoid trading based on fear and greed. And patience, wait for good setups. Do not force a trade. Do not try to bet against the market. And most importantly, do not revenge trade. And trading psychology is a very well-studied topic. There's lots of TED Talks about it. There's lots of training courses on it. It's something that you definitely should learn if you're going to get into trading, because trading is a mirror and it will show you your own reflection. And then number 8 is tools and platforms. So you're going to need a brokerage account. Like, where do you want to trade? You could trade on Swap, Thinkorswim. You could trade on Fidelity. You could trade on Robinhood, Webull, Tasty Trade, and there's so many others. And then there's charting software for analysis like TradingView and Thinkorswim, which are some of my favorites. And then news sources, where are you going to get your news from? Yahoo Finance, Bloomberg, there's, stocknews.com. The Trading Agent has very powerful news as well, and I'm going to show you guys how to use that here in a little bit. and then some actionable steps to start. So the first thing you're going to want to do is open up a brokerage account, research your fees, tools, and support. Learn charting basics, practice reading candlestick charts. Start small, use a demo account and or trade with small amounts. So a lot of brokers offer paper trading, and that's a good way to kind of get the feel for placing orders and getting used to, setting your orders and setting up your trades and doing your analysis and stuff where you're not actually risking real money yet until you feel comfortable. And then set a trading plan, define entry, exit rules, risk per trade, which the agent's going to help you do that, and track your trades. Keep a journal to learn from wins and losses. And then it provides some recommended resources and common mistakes to avoid: over trading, too many trades. A lot of times traders will make a trade, they'll get a profit, and then they'll trade some more and they'll give it all right back to the market. So over trading is a good way to lose your money. Ignoring risk management, moving your stop loss, thinking that the market's going to recover, not having a stop loss, not managing risk, and not managing the losing aspect of your trade is a good way to blow up your account. And to blow up your account essentially means either getting a margin call, losing all of your money, and essentially just making it so that you no longer have capital to trade. And then letting losses run without a stop loss is a common mistake to avoid as well. And so those are some of the things that you need to know as a new trader, right? And so now we're going to assume that you have a brokerage account, that you have maybe some type of investment experience, and we're going to look at strategies for stocks. So let's look at first day trading strategies. So here are the top day trading strategies that recommended by the agent. The first one is momentum trading, and the concept here is to trade stocks moving strongly in one direction, up or down. And so when you're dealing with stocks or any type of trading, you have two axioms. You have buy low, sell high, which is called going long, and then you have sell high, buy low, which is known as going short. And so momentum trading is when you see a stock moving strongly in one direction, up or down, with high volume, you apply one of those axioms. And so how do you do this? You identify stocks with news catalysts or big price moves. Enter when momentum is confirmed, exit before momentum fades. And the agent will show you what levels to watch to find those confirmations and those exit points. And some of the tools you can use is news scanners, volume spikes, and moving averages. Number two strategy is breakout trading. Buy, and the concept here is buy when the price breaks above resistance or sell when it breaks below support. And so support and resistance are two key measurements that traders use to know when to enter and exit a trade. And so essentially support is when the stock price drops to a certain point and buyers say, okay, this is a good entry point, we're going to start buying it up. And they'll start buying it up, and then that drives the price right back up. And then resistance is when the price goes up and traders say, okay, I'm ready to take profits, I'm ready to sell, and I want to start reaping these profits. So I'm going to show you here on the chart what support and resistance looks like. So you can see here on the Microsoft chart on the daily time frame, essentially this green bar at the bottom is a support. And then you can see here you have a green bar and a red bar. So the green bar is support and the red bar is resistance. And so you can see back in May, it broke above support for a major rally. And then it found a little bit of a resistance here around September. And then it found some support there, broke above. So you can see the buyer stepping in, driving up that price. And then the seller stepping in and saying, okay, I want to take my profits. And that drives the price back down. You can see here in early November, it broke below support. So now that support level became a resistance level. And you see here, it tried it again, but it never was able to break above that resistance level. And now you can see here that the price is being driven back down. And so now you're in this awkward place between a resistance level and a support level where it's kind of just channeling in the middle. And so that's support and resistance. And so that's something that you'll need to watch out for, because a lot of times the market can reverse on you. And so paying attention to support and resistance levels are key to your success. And so with breakout trading, what you'll do is you'll set alerts at key price levels, enter on the breakout, and set the stop loss just below the breakout level. So what you would do here, so like you would set an alert for Microsoft, and you would say, okay, I'm going to add an alert so when it breaks above this resistance level. And maybe I want to set an alert here, and I'm going to set my stop loss right below this resistance level. And then so what I'm going to look for is a setup like this, right? Where I want to get in when it closes above this level. And then hopefully it'll ride up just like that, and I can take some profits. And then, so like in this case, that's a $30 gain. But then also, if it comes right back down, you'll exit here instead of all the way down here. And so then that could save you about $40, $50, and so that's a good way to position your trades and manage your risk there. And so that's what's considered a breakout. So some of the tools are support and resistance lines like I just showed you, and then there's charting patterns like triangles, rectangles, head and shoulders, some of the other. And then there's a concept of a reversal or mean reversion trading. The concept is to trade when the price is likely to reverse after an extreme move. And so these are when stocks have maybe hit an all-time high, they're overbought or oversold, and using conditions like RSI, which is the relative strength index, or Bollinger Bands. Enter when the reversal signals appear. So that's typically some type of a crossover. And so some of the tools used there are RSI, Bollinger Bands, and candlestick patterns. And then number 4 is scalping. So scalping is make many small trades for tiny profits. Enter and exit quickly, often within minutes. Focus on liquid stocks with tight spreads. So some tools used for scalping are level 2 quotes, time and sales, and fast execution platforms. And then the VWAP strategy. So use the volume weighted average price as a guide, which VWAP is a technical indicator. Buy when the price is above VWAP, which means it's bullish. Sell when it's bearish, which means it's below VWAP. VWAP acts as a dynamic support and resistance. Tools are typically the VWAP indicator on charts, or you can look at VWAP in the level 2 in your broker, which we'll cover that in a little bit. Some key tools today trading are real-time charts, typically with 1 to 5 minute intervals for quick entries and exits. Level 2 quotes, which are the order book depth, and that kind of shows the flow of orders coming in for a stock. And then news feeds and for catalysts, and then hotkeys for fast order execution, because you got to get in and out, when you're day trading. And then risk management tips: set stop losses on every trade, limit your position size, maybe risk 1 to 2% of account per trade. Avoid holding overnight. And the reason for that is news can happen overnight, things can happen overnight that can cause the market to reverse against you. And so holding it overnight does add additional risk. And then keep a trading journal to review mistakes and successes. And then there's some further reading and resources. So let's look at one of these strategies. Let's look at breakout trading. Example of breakout. Let's dig a little bit deeper into breakout trading, because that's a pretty common one. So here's a breakout trading example of the step-by-step, and again, it's showing you the power of the agent and how it's able to help you understand these trading setups and make this a lot easier for you. So your market context, so we're going to use Apple as an example. We're looking for a breakout above a recent resistance level. And so, first the first thing we're going to do is we're going to identify some key levels. So resistance is the price where the stock has repeatedly failed to move higher. Support is the price level where the stock tends to find buyers. And so looking at Apple price, the current price is $286.30 with recent highs of $287.40, which was yesterday. And recent resistance around 283 to 287. Multiple attempts to break above, but they failed. And so your technical levels are: your resistance zone is 283 to 287, and your support zone is 276 to 278. So that's your channel. High volume breakout days with 54 million shares was on December 2nd. And so here's your breakout setup. So entry, which is when you're going to buy into the stock. So buy if the price breaks and closes above 287.50. So that's confirmation above resistance. And then your targets. So your first profit target and your second profit target. And what this does is this gives you different levels to be able to take profits at. And lock in those profits. So your first target would be 292, which is a psychological number level, and what that means is it's a whole number that is psychologically appealing to people, and so it's going to be the next likely resistance level. And then your target 2 is 295, which is an extension target if momentum continues. And then your stop loss is place your stop loss below the breakout level, so around 284.50, just below your resistance zone. And so that's your risk management. And then your position size, you're going to risk 1 to 2% of your account per trade. And so what this does is this provides you with a well-rounded trade. And a good trade contains 3 components: an entry, where you're going to get into the trade at; your exit, where you're going to take profits at; and your stop loss, if the trade goes against you, where you're going to exit at, so that you don't lose all your money. And so all of your trades should have these 3 components. And that's how you know if you have a good trade. If you do not have these 3 components, it is not a good trade. Winning and losing is not the measurement for a good trade. It's the setup that's the measurement for the good trade. And the reason why is because that allows you to have risk to reward ratio. And your risk to reward ratio is what's going to determine long-term profitability. And we're going to get into that a little bit later. And so, here's some risk management. So high volume confirms breakout strength. A tight stop loss protects against false breakouts. And don't chase if price quickly reverses below resistance. And it gives you an explanation as to why this works. So breakouts above resistance often attract buyers, especially with strong volume. Setting clear entry and exit rules help avoid emotional decisions, and that's the key. And so the goal of being able to make this trade and setting up this trade properly is that you can just walk away from it. And then, it's either going to hit or it's not, but you don't have to sit there and stare at it. And so your summary table provides you kind of a brief breakdown of the whole trade. And so, you got your entry, which is above resistance, your target 1, which is your next resistance level, your target 2 is an extension target, and then you got your stop loss which is below the resistance zone, in case the trade goes against you or it's a false breakout, and then your position, which is 1 to 2% risk, and that gives you account protection. And so that's a good example of a breakout trade. And so let's look at one other strategy. So let's look at momentum trading. So momentum trading example, and on this one, we're going to use NVIDIA. And so the number one is the current trend and market context. Momentum trading focuses on stocks making strong moves with high volume, often triggered by news or earnings. We'll check NVIDIA's latest prices and recent volume spikes to spot momentum. And so the current trend for NVIDIA is the current price is 182.85. Recent highs is 185.66, which was yesterday. Recent volume is 182 million, which is well above the average. Trend is strong upward move from 174 on the December 1st open to 185, which is the yesterday's high with high volume. And key indicators is the volume spike. November 25th saw a huge volume spike of 320 million shares, and the price jump confirming momentum. Price actions, a series of higher highs and lower lows since late November, and momentum confirmation. Price breaks above the previous resistance, $180 with strong momentum. And so here's your trading plan for your momentum setup. Your entry is going to buy as the price breaks above 185.70, which is a new high confirming momentum. And your target 1 is going to be 190, which is a psychological round number like we talked about earlier. And your target 2 is going to be 195, which is an extension target if momentum continues. And the reason why it's giving you 2 targets is the target 1 is a reasonable psychological number, and so you're going to lock in some profits there. But then also you'll have an opportunity to, leave some behind just in case it continues to go, and then you can capture in on some of that as well. And so let's say for the sake of argument, for the sake of math, you buy 10 shares, right? And maybe you'll sell 7 shares at target 1, and then let 3 ride and try to get out of those at target 2. And then that way you'll lock in some profits, and and then if it continues to go up, you can capture on that upside as well. And so your stop loss is going to be below recent support, which is 179, just below the swing low. And your position size, again, is 1 to 2% of your account per trade. And so some risk management here is high volume confirms momentum strength. A tight stop loss protects against sudden reversals. Just in case the momentum dies out for whatever reason, the market reverses against you. There's some macroeconomic event or something that happens. Maybe it's not directly related to NVIDIA, but could be some bigger event that happens that causes a market downturn. And then don't chase if the price quickly reverses below the breakout level. A lot of times people want to try to force the trade. They want to try to force the market to do what they want it to do because they want to have some control. Do not try to have control. You do not control the market. And then kind of gives you a brief analysis of why this works. Momentum traders capitalize on strong moves with volume, often driven by news or earnings or other economic events, and it provides a clear entry-exit rules to help avoid emotional decisions and maximize gains. And then it provides a brief summary table. And so those are just two of the many trading strategies that traders use when they're trying to trade stocks. And so I hope this helps you on your trading journey. And you can use the agent to ask it more questions. Ask it what any of these things mean. It'll give you a break. It'll give you a breakdown. So, like for example, what does MACD mean? You can ask it any questions about any of these things, and it'll give you a deeper explanation into it and explain to you what it all means. So MACD is the moving average convergence divergence, and how it works is the MACD line, the difference between the 12 period and the 26 period exponential moving averages. The signal line is a 9-period EMA of the MACD line, and the histogram, which is the difference between the MACD line and the signal line, visualizes momentum. And what it shows is it shows trend direction. When the MACD line is above the signal line, it suggests bullish momentum. Below means bearish. The farther apart the lines, the stronger the momentum. And so people can use this for buy-sell signals. So when the MACD line crosses above the signal line, it's often a buy. The bearish signal is when it crosses below the signal line. And so that's what MACD is. And then traders use it to spot trends early, confirm momentum before entering trade, and it works well with other indicators like RSI and volume. And so this is a good example of how using the agent not only can help you set up trades and understanding what trades you need, what trading strategies are available to you, but it can also explain to you anything that you don't understand if you have questions. And so it's almost like your mentor or your personal trading guru to help you understand and get a better grasp around trading and investing in the stock market and the options market. I hope you enjoyed this video. If you have any questions, drop them in the comments. If you like what we produce, please like and subscribe, and thank you.